So, what tech founders get wrong about risk and how to fix it early. So, hi everyone, and thanks so much for joining us this morning for today's webinar. What tech founders get wrong about risk and how to fix it early. I'm Gemma McLaughlin, Audit Director here at Gravita, and I'll be hosting the panel discussion today. And for those of you who might not be familiar with us, Gravita is a full service accounting and advisory firm working with ambitious businesses at every stage of growth. We support a lot of fast-moving, founder-led companies, especially in the tech space. And we know just how easy it is for risk planning to get pushed to the bottom of the to-do list when you're focused on launching or scaling. That's exactly what we're here to talk about today, the common gaps and blind spots founders face, particularly around legal, financial, and hiring risks. We've brought together an expert panel to give you real-world practical advice across those three core areas. Whether you're just getting started or trying to grow sustainably, there'll be something useful for you. Now let's kick things off with some quick introductions from our panel, and I'll ask each of you to tell us a little bit about who you are, the kind of clients that you typically work with, and where you support them. So let's start then by asking Vicky.
Good morning. I'm Vicky Grobbelaar and I'm founder of Ethiqs Legal. I've got 24 years legal experience in practice across jurisdictions, of which 18 dedicated to tech. Yes, I get excited about SaaS agreements, AI challenges, and whatever's next in biotech. We work exclusively with tech companies at Ethiqs Legal, and we've got clients from multi-billion-dollar wearable tech giants to biotech spin-outs from universities, gaming platform developers, startups and scale-ups, just like you, and people in this cybersecurity space. We specifically deal with technology law, data protection, and commercial contracts, kind of all the legal infrastructure that you need as a tech company for innovating. And what makes us different is that we speak tech. We price everything upfront like a SaaS model, and we speak plain language and move at your speed. After nearly 2 decades in this space, I know that legal foundations either accelerate growth or they become the bottleneck that kills you. So that's why I'm passionate about today's topic of getting the fundamentals right from day one.
That's amazing, Vicky. Thank you very much. Over to you, Ben.
Thanks, Gemma. So Ben Chernoff, one of the partners at Gravita. I also head up our tech sector. So I've been working with clients specifically in the tech sector for probably the last 15 years. It's one of the real passionate areas of mine. And whilst I do deal with other industries as well, I think the tech sector is definitely the one that I'm most passionate about. I deal with all size tech businesses, so from very early seed round up to probably Series E, Series F, as they're raising kind of hundreds of millions. And we've also dealt with businesses that have gone on to be listed. In terms of the services and how we support our clients, it really does vary based on what they need and the size of those clients. But we can help from very early setting up, incorporating that registering, getting your system set up properly, up to helping with investment rounds and liaising with your corporate lawyers, with Vicky's team to help from the legal side. We can also assist with forecast planning and cash flows and business plans. As the businesses grow, we get involved in the audit side, especially on the tech side for the first few years. My passion is about helping the founders and supporting them as they go through the different phases of the business, from bootstrapping up to raising money and knowing where to best spend that money and what their kind of run rate looks like over a period of time. So yeah, really passionate about the tech sector, and there's a lot of issues that people don't realise, and I think it's great to go into depth on those today.
Okay, amazing. Thank you, Ben.
Hi, good morning, everybody. I'm Mark Baker from Claremont Consulting. We're a talent solutions recruitment business. I'm the founder director. Business was set up in 2002, so it's been running for 23 years now. Personally, I've been working in the recruitment space for over 35 years. Claremont have grown, initially set up by myself and business partner. We've grown now to 60 people across different venues, different continents. Head office is London, but we also have offices in the US, Hong Kong, Germany and the Netherlands. We do have entities set up in Mexico, Slovakia and Ireland. Business started in 2002, primarily focusing on UK market and working with different clients, a lot of bigger corporates initially. But that's evolved now into working with clients across the globe, primarily tech. We've got an outsourcing service that does cover a variety of other roles outside of tech, but 95% of the business that we do is within the tech area, tech space, and we hire for both full-time permanent employees and contractors. And we can hire teams, we can hire individuals, and the roles that we hire for range from CTO right down to first line support people. So yeah, we've built a team now that specialises in hiring for tech startup and scale ups, and that has primarily been in the UK and in Germany. Obviously, there's a huge market in the UK for tech startups, scale ups, but also in Berlin. And what we do is work very closely in partnership with businesses that are looking to scale quite quickly, founder led. Founder is focusing very much on the business, and we will work in partnership with them to ensure that they hire the right people at the right time.
So a real global reach as well, Mark. Thank you.
Yeah.
So Vicky, from a legal perspective, what are the most critical foundations a tech business needs to have in place from day one? And what are some of the legal issues that you've seen that could have been avoided with early planning?
Sure. So I've also been around, so I've seen lots of things. I think I'm going to touch on 3 pillars, which I think is important today that every tech startup needs from day one. The one is clarity around IP ownership, who actually owns what you're building. Data protection basics, because you're going to probably deal or handle customers' data. And depending on if you have plans to scale, which everybody has, don't think about now, think about later, get those in place. And then commercial terms, how you actually make money legally and what kind of agreements do you have in place. I talked about IP ownership clarity. We so often see that clients think that they own something, which they don't, because they assume that if they have a contractor and they pay that contractor, that product is theirs, but it isn't automatically. You need a good contractors agreement, and everybody uses a lot of contractors. That's really something that's very important. If you get these wrong early, you're not building a business, but you're building yourself expensive problems. I've seen companies spend 50K fixing legal issues that could have cost them 2K in the beginning. Client that built a beautiful B2B freelance employment platform for a specific industry, very excited and passionate about it. The problem is he didn't quite understand the legal nuances and the rules in that particular industry around IR35, contractors versus employment. And literally, they lost 3 months, 50K in building costs. They had to redo the whole thing because they didn't spend that one consultation fee in the beginning that would have flagged it for them. Another one I can think of is IP. I always keep hammering on IP. And just so I'm clear, I'm not an IP lawyer myself, but I've got someone on my team that is very good. Tech company with enterprise clients, they were struggling with margins. They didn't quite understand why the business, is really struggling while other people are doing well. And it was purely because they didn't quite understand the IP rights that they had in their contracts. They were stuck in a low margin, high effort cycle where they kept reinventing the wheel, basically. Once they understood the options, they unlocked this whole recurring revenue stream. So it really made a difference to their business. The other one that's really prevalent right now is what I call the AI dependency disaster. People start to build the entire product around a third-party API, and right now lots of people are doing this with ChatGPT. They have no contract in place. They have no contract or terms covering service availability, maybe rates, limits, if they are even going to be around for the next year or two. But what they do is they use a contract and make all kinds of promises to their clients about outages and all that kind of thing. And then sudden realization that you've overpromised and you have nothing to back that up. In this particular case, client ended up with a 30K claim from a client because they couldn't actually make good on what they promised. Big reality right now, what I hear weekly is ChatGPT gave me a contract template, so I'm sorted. Really dangerous. Particular client that I've got in mind used it to draft their SaaS agreement. Looks really nice, look pretty, nice wording, plain wording, whatever. Unfortunately, it included clauses that is not enforceable in the UK. They missed critical data protection requirements. It actually made them liable for things they didn't know they were going to be liable for. A client dispute that cost them 20K could have been prevented. Just have someone look at it. And what I'm saying right now is I'm an absolute enthusiast about AI. Love AI. Great tool for many things. But my question right now is, would you let ChatGPT perform surgery on you? Probably not yet. So I think treat it in the same way as far as your legal agreements go. So, clauses like liability, there's some generic garbage that it turns to garble out, outdated information, or maybe it's a US contract that's not even applicable to UK law or English law, doesn't have your context, and it's only as good as what you put in, as we all know. So that's a real danger.
I've actually got a question on the IP front.
Sure.
Having a lot of clients contact me about moving overseas and setting up businesses overseas, especially over the last kind of 12, 18 months. So I guess obviously we know the risks of an IP. Could you maybe talk about if you are looking to set up overseas and the areas you need to consider from an IP front?
Sure, Ben. So just so I reiterate that I'm not the IP lawyer on my team, so I don't want to give you the wrong advice. However, we absolutely help with that. Certain countries do have certain rules around how IP moves around and where it is actually resident, if I could call it that. So it's really important to have that discussion and have it very focused on where are you intending to move the IP, or what is the structure that you are intending to use. And there is definitely ways to deal with that.
Yeah, I see a lot of clients just think they can just move overseas and not actually worry about these certain areas.
Correct.
Actually,
absolutely.
Make sure you speak to your lawyer before you just.
Yes, and I think that's where my IP, question in the beginning comes in. Make sure you own the IP. What we see often is that two people start up as founders. Obviously, they love each other at that stage. They're excited about the business. They put the basics together from an IP perspective, and only later do they actually form the company. They never put the right structures in place. They don't assign that to the company. So the company actually never owns that IP. And then the fallout happens where the founders don't like each other that much anymore. And one realizes that actually the IP is not in the company. It's with a particular founder. And that can be an absolute disaster, obviously, for a business. If you look at investment stages, investor won't touch a business where they're not sure that the IP is actually owned by the company. So that can really put you back to the back of the pile if they are looking at you for investment.
Yeah. Thank you. And Ben, many founders delay putting financial systems in place and often will do their accounting themselves. What are the risks of doing that, and with a view to surviving and then growing?
Yes, I mean, look, we see a lot of founders who at the very early stages are either funding the business themselves, or they're very bootstrapped, or they've got some kind of family and friends that are helping to fund the business startup. And they're obviously looking to try and reduce cost and really put the focus into the product. And I think some of the areas and recommendations I would say is, one, focus on the areas that you're good at, which is probably the product and what you're trying to develop. And whereas you obviously need to make sure that you've got funds to be able to invest in that. I think having the right team around you and the right professional support makes a big difference. I speak to a lot of founders and they just kind of want to get running before they've actually thought about what needs to be set up. Can you register as a tech startup with no revenue? And what are the pros and cons of that registering? Well, actually, if you're spending hundreds or thousands of pounds and there's a VAT element, you can potentially claim that back, even if you're not revenue producing on day one. And a lot of founders don't actually know that. So again, speak to the right people and make sure you get that in place. And if it works, you can start claiming that back on day one. The other key thing that I would recommend is, and again, we work closely with Vicky and the team on the legal side, is your cap table. And I think as you start bringing in investors, no matter the size, whether, like I said, it's family and friends, or you kind of move to more seed or Series A, having a proper cap table that's in place that everyone's agreed to and is kept regularly up to date is vital, because the amount of times that we have clients come to us that it takes thousands of pounds of cost to try and work out what has gone on in terms of share issues, share transfers, who's paid what for what share, because nothing's been logged properly. And it can really kind of get into a right old mess. And where there's potential tax savings for investment, if you're looking at something called SEIS investment for very early stage businesses and EIS investment, and there is strict criteria and rules on how these work and the right order that cash has to be paid, shares have to be issued, and the forms have to be done. If they're not done in the right way, the revenue won't allow the individuals to get those tax relief. So if you've gone to someone and said, can you invest £50,000 into my business, you'll get SEIS and you'll get 50% of that back as tax relief. And then a month later, you go back to them and say, oh, sorry, I actually didn't do it in the right order, and you're not going to get any of that tax relief. You can quickly get some very unhappy investors. So I think just making sure you follow the right steps, you speak to the right people, whether that's your lawyer, your accountant, and these are very good tax schemes to encourage early stage startups to get investment, but you need to make sure they're done right. So I think having a detailed cap table and speaking to an advisor early on to make sure you're getting the right advice. In terms of just having like an actual software to manage your bookkeeping and processing your transactions, I think, again, a lot of early stage founders kind of think it doesn't matter for the moment. I'll keep a file with all my invoices and I'll worry about it kind of later down the line. And again, we then end up spending a lot more time and cost to try and work out what they've done. Actually, I paid for this contractor invoice out of my bank account, I paid for this other one out of my mum's bank account, and actually trying to piecemeal what the company has spent. And where this becomes particularly important is where if a company wants to, for example, make an R&D tax credit, a lot of that is based on what the companies have spent and how they've spent it. If we haven't got the copies of the invoices or how it's been paid for, and a year's down the line when you want to try and get a tax credit and you're saying, well, I've spent £100,000 on my product, and we're saying, well, we can't see where that 100,000 has been spent, or we haven't got backing for that, it's going to restrict any potential credit that they might get. So having a detailed or having a financial system in place. So at Gravita, we would recommend Xero. We use Xero for a lot of our clients. Having that set up on day one, linking it to a business bank account. And again, making sure that you actually have got a business bank account and you're not just using your personal bank account, because again, that can cause issues. Coming back to the IP point that Vicky made, just using personal stuff to pay for certain transactions might mean that actually the business doesn't own that and that's owned by individuals. So again, I think these conversations just need to be had at quite an early stage. And I think at Gravita, we do understand how early stage startups are restricted on the cash they have. And we do try and manage our services that as the business grows and expands and has some more free cash, that we can then grow our services as the business kind of transitions on. So I think they're kind of the main areas. I think the last one I just want to touch base on is equity and share options, because I have a lot of conversations, especially recently actually, with founders wanting to give away equity or share options to, whether that's, I had one last week where they had an advisor that was doing some work for them, and as part of the agreement with the advisor, they're like, oh, don't worry, we'll give you 10% of the business for this work. And actually, they've not thought about it from a tax point of view, that that advisor is providing a service, and in lieu of that service, they're getting shares. So the revenue could look at that and say, well, actually, that service would have been £10,000. We're going to tax that person as income tax on that £10,000, even though they're getting shares in lieu of actually of that work. So I see that a lot, promising of equity and not thinking of the tax implications.
Point.
Yeah. And also on the share options front, I'd say try and, as the business grows, you want to become protective of your equity. I see a lot of founders quite early give away quite significant equity. As you bring on and do more investment rounds, that gets heavily diluted. And the amount of conversations I've had 2-3 years down the line that the founders say, oh, I wish I never gave that equity, or actually I wish I became a bit more protective of my equity at an early stage, because once you give it away, it's very hard to get it back. With the share options, if you're having a 10%, 15% option, just be careful of how you're splitting that up. Options are slightly different. You can get them back. They're a lot easier than actual share capital. But again, just be be aware that if your investors have agreed that you're going to have a 10 or 15% share option pool, that can only go round to a certain amount of people. So if you're bringing in a CTO and you want to give him 10% or 5%, it doesn't leave much left for any future hires. So yeah, I think that there's some key things to get set up and think about early on.
Yeah, Mark, you must see that even from a hiring perspective. I guess a lot of people want in their contracts, there's going to be options further down the line. People offer it as well in tech industries to try and keep good people. Isn't that right, Mark?
Absolutely. That's one of the questions I was going to ask you actually, Ben, is are you seeing any switch from share options, EMI schemes to EOTs, employee ownership trusts? Is that a better route for a scale-up business to look at?
No, it's interesting. I think we have seen a lot more of EOTs recently. I think EOTs we see a lot more later down the line when there's already value created in the businesses. Share options are great for early stage startups and even quite often Series A. As you get to kind of Series B, Series C, because of the asset thresholds and the limits on EMI schemes, unapproved share options are not as tax advantageous. But from an EMI scheme, if you get these set up at an early stage, you can basically get valuations normally agreed with HMRC at next to nothing. And therefore, the incentive to the employee is you're getting an option and effectively paying nothing. And you're going to get all future growth at a very low capital gains tax rate. So I'd say for early stage startups, I still think EMI schemes are definitely the best. I think as the business grows and develops and there's value created, I think EOTs again are another great way of incentivizing employees. And also where you've got overseas entities, that can add some layer of kind of technicality from a tax point of view for share options. But yeah, again, EOTs we've done a lot of the last kind of 24 months.
Yeah, so basically what's needed is a lot of planning and safeguarding before steamrolling and the setting everything up and running with the idea. It's trying to take that step back approach, which is hard when you've got someone that's got a great vision and they're really excited and they're ready to go, and they maybe have somebody that they've brought on board that's absolutely brilliant and they want to make it happen very quickly. But it's nearly like we talked about, like a bit of a checklist, isn't it, Vicky, to kind of ensure that people are ticking off certain things before they even start stepping into this kind of venture?
Absolutely. The paperwork for that really needs to be in place and correct, because otherwise it could bite you later on.
Yeah, I'd say it's something I would always say to my clients is before you're making these key kind of decisions, or I want to give this person 10%, or I want to make this hire with these incentives, just pick up the phone and give your advisor a call, whether that's your accountant or your legal team, and just say, this is my idea, does it work? Before you start promising the world, because it's very hard to, once you've promised something, to then start trying to unwind it and start upsetting people. So I'd always say, speak to your advisor, come up with something great, speak to your advisor. If you've got the right team around you, I'm sure they're always willing to help and try and advise you, and do that pre-making those kind of having those conversations.
I think that's a good point, Ben. People tend to think that it's going to cost me a lot, but most of us will gladly take that phone call and give some advice and just give some basic things to think about before they start that journey without any cost even.
Yeah, I think that for us, especially on the tech side and how we work with our tech clients, it's all about the long-term relationship. And for me, especially, I could work with tech businesses most of them we work with for years and years, and therefore we're not the type, especially myself and Gravita, we're not the type of people that if you pick up the phone and give us a call, you're going to get a bill through the door. So we're there to support you and help you go on that track. We hope that in 3 years or 5 years, these businesses are unicorns. We kind of try and look at the long-term view. I think we also know that at the early stages, there's an investment from us as well, because we're putting time and energy into these businesses and probably not getting paid for all of our time at the early stages. But we hope that the long-term relationship kind of makes it.
I mentioned that because I know that there's been some studies recently that says that's one of the biggest barriers. That's why businesses say, well, we didn't know because we assumed it was going to cost us a lot, so we didn't ask. So I think that's important for people to know that we are just a phone call away sometimes, and it's worth asking.
Yeah, even a business the size of Gravita as well, people sometimes are afraid that we're maybe a bit too big. But we are dedicated to the SME market, and we are a company that's come together with, we've grown through acquisition as well. We have a client base, we have a level of partners and knowledge, and that partner approach is still there. So as Ben says, that real investment in the beginning, there's a lot of innovation out there, and some businesses take off really, really quickly. Some, it can be a slow burner and things like that, but that's where the relationship comes in, and we're all interested to be invested in that.
Absolutely.
Yeah.
Ben, I want to take one step back, please, if I can, and ask you a question, because this is something I often hear. People at the very early stage of startups say, well, everybody's throwing around these terms and they assume that we know what it is, and what the heck is a cap table, for instance. So I've heard that question quite a lot. Can you just explain briefly, please?
Yeah, so effectively, a cap table is a list and a breakdown of who owns the equity in the company. So let's keep it very simple. There's 100 shares in a company. Who owns those 100 shares? What percent do they own? And what amount did they pay for those 100 shares? So as you can imagine, early stage, it's normally quite simple. There might be one, two, or a few people. But as the businesses grow and you kind of get down to doing Series A, Series B, even down to Series F and kind of the very large businesses. I mean, we've got some tech businesses that we might have 200 shareholders on those cap tables, and therefore having, whether that's systemized, we still have some minutes to get back. I much prefer that they're systemized as they get bigger. But yeah, having that detailed list of the shareholders, kind of what they own, how much they paid for it, what share classes they have, those kind of things. So that's what you would normally find on the cap table.
Thank you.
Thank you very much. Okay, so over to Mark then. Mark, hiring is one of the biggest challenges of a scaling company. What's your advice for getting the first few hires right? And what common hiring mistakes do you see founders making when trying to grow too quickly?
Well, along with Vicky and legal processes, and Ben and making sure your finances are right, hiring first few new team members is one of the most important things scale up business can get right and have to get right. So your early hires, they don't just fill a role. They help shape the culture, they help set the cadence and the pace of how the business is going to grow. And more often than not, they become the future leaders of the business. So in terms of getting it right, advice has a number of points. I'd hire for trajectory rather than skills that they've got currently. So really in the early days, you need people who are going to learn, they're going to grow with the company. More often than not, you'll find that good enough generalist who's highly adaptable and flexible is probably going to outperform somebody who's a real specialist and only really can thrive in a sort of narrow lane, only has a narrow level of experience and hasn't got that adaptability. Scale-ups can be quite chaotic. So you've got to look for people who can grow with the company and can perform in that type of environment. My advice is skills can be taught, but what you don't want is somebody who's going to join the business whose values don't align with what your long-term aims are. So the first hires should really deeply believe in the business, the product or the service that you're providing. They should be excited about the journey. You want people who firmly believe in your mission and excited about where the company can go, what the journey is going to look like. They're not just interested in the paycheck at the end of the month. And you want people, don't just interview and hire people based on their skill set. You want to, particularly when you're interviewing them, give them a real life problem to solve. Don't just ask about their CV and career history. Give them a sort of scenario or a small project that potentially is something they're going to pick up when and if they join you, because it will give you the opportunity to learn more about how they think, how they collaborate with others, how they communicate, potentially under pressure, but how they really communicate and can show their sort of flexibility and adaptability. They're the real key traits I think people should be looking for when they first few hires that come in. And advice would be take your time. You might be under pressure. You might have your investors asking for growth plans, but take your time to get the right person. The temptation often is just to get someone in to fill a seat, but a mishire at the start of your scale up could prove really costly. not just financially, but time-wise as well. It can set projects back, it can put your growth plans back. Also, it can impact the whole culture of the business. One or two wrong fits in the first 5 to 10 hires as you scale the business can have a massive ripple effect for the whole team. So you really want to ensure that you're hiring people that you think are going to align with your values and culture. They're the main points of advice. In terms of common mistakes that I've seen founders make before, it all goes back to your hiring. Don't hire for today, hire for tomorrow. Pick someone who can do the job currently in the current tasks. They've got to be able to scale with you as well. You don't want somebody, what's the terminology that's used, jobs worth, somebody who's, well, that's not in my job description. As I said, it's an exciting time scaling a business, but there's lots of different roles and jobs that need to be done, and you can't just join a scale up and expect to be doing one thing and one thing only. You've got to basically roll your sleeves up and muck in and help the team. Startup work can be chaotic, as you all know. One of the mistakes I've seen people make, particularly over the last few years when there's been a slight shift in the market and it's become much more candidate driven, is there's a lot of candidates have come from big tech giants with all the various layoffs and redundancies they've made. And some of the mistakes I've seen is people have been sort of almost excited about, oh, we could hire someone from Google or we can hire someone from Facebook. But these, more often not, they can work in they're very good, they work in a very structured way, but they haven't got that flexibility and adaptability in their DNA. A business like Google, it's run by manual basically. It's very structured. And again, you want somebody who's going to fit in with a much smaller team and is going to be adaptable and work to what you want them to work to, rather than they've got a very structured pathway from their previous career. As I say, your early hires define how we do things here. One poor hire can really set a precedent in terms of a toxic culture. It can erode trust. So you've got a lot of balancing to do as a founder to find the right people. And then as a founder, you've got to believe in yourself. You've got to believe in your product, your service. So you have good candidates at the moment still, even though the market has shifted to being candidate driven. Good candidates have a number of options. So you've got to really sell your opportunity. Don't under communicate what you're doing. Don't undersell the business and the growth path that you're on. Give them the long-term upside. As Ben said, there's potential to give equity and share options. That's great, but you've really got to sell them the dream really of where the business is going, what you as a founder are going to be able to do to help them with their career, and ultimately where potentially they can take their career within the business. As I mentioned earlier, they can become a future leader of the company. And that's the type of individual and personality that you should be looking to hire.
And that's some of the things as well. A founder might find it very difficult to understand what vision and strategy looks like for the next 5 years and 10 years to get that real buy-in from their staff. That's where kind of like, even having things like your forecasts in place and things like that is really, really important, even if they need tweaked as it goes along, because nothing stays the same. And you have to be able to, in this fast moving world, is getting faster and faster, you have to be on board with change all the time.
Absolutely. But you should definitely have a structure in place, give people an idea on plan and where the business is going. But hire slowly. Don't hire the first great developer or business analyst or project manager that comes along. You need to make sure you get the right fit. Choose people who you trust to represent you and your business if you weren't in the room. They've got to be an extension of yourself.
Yeah.
Gemma, just want to add a few points I've seen from a staffing front. So I think I have a lot of conversations at the early stage of businesses about, I want to hire this person. Can they be a contractor? Can they be an employee? It's a lot easier if I put them as a contractor. So I think if you are thinking of that way, please speak to the right advisors, because there can be pitfalls in hiring them as contractors. I think I mentioned earlier about having a lot more conversations with people moving overseas. And I think just be aware of that there's different tax implications of having overseas employees, and trying to incentivize employees if they're based overseas. Things like EMI schemes might not work. So I think just be careful, and again, having those conversations that if you want to hire an engineer based overseas and not in the UK, and you're a UK company, what actually are the implications of that from kind of tax and legal point of view?
It's a good point, Ben. I think the idea is that later on in this series of webinars that we will have, that we'll definitely dedicate a section to the employment law, because that has actually changed a little bit in the recent past, and not many people are so aware of that. So it used to be that you could take a while really before you needed to think about employment contracts, for instance, and that has changed. So that's a very good point. And we'll make a distinction, look at employment contracts versus contractors from a legal perspective.
And I think just last point on that also, I think Mark made a very good point about rushing hires. I see a lot of startups that they do a Series A, they raise £5 million, and they go, right, on our business plan, we've got to get up to 100 staff in 6 months. So they get 100 staff, and then they realise, actually, what have we done? Our burn rate, we're going to be cash out in 6 months. And then they start getting rid of half of those people within the next 3 months. So I think having a proper structured plan on actually steady growth, and yes, you might need to get some people in urgently to really push the business forward, but having the right people for the right reasons, and not just to have numbers and kind of heads on seats, because it can really put the business back. And if you go from 100 staff to 50 staff, I mean, I've seen some where businesses have literally gone from 250 staff down to 90 staff in a 6-month period, and it just causes so many challenges for the business.
There's a massive cultural impact.
And negative. That's what I wanted to say. Negative impact, really. That's where I think all of us come in as well. Don't forget that you don't always have to have a hire. You can have fractional general counsel. So we offer that, where we come in specifically for startups. So we've got different packages that suits budgets, where it's budgeted for, and we are on your team, but we are not a permanent hire. You don't have all the employment issues. Similar for you guys. So I think everybody can work like that. So outsource where you can, and it makes sense, particularly in the beginning.
Yeah, so we have a good question there as well that's just come in. The question says, all of this advice applies to non-tech startup companies as well. Yes, definitely. Mark is very dedicated to the tech industry for recruitment, but regarding legal and accounting, that is definitely applicable to all businesses.
I would say the cost of that is certainly from the staffing and recruitment perspective, all of that advice would apply to non-tech startup. Exactly. It's not an area I work in, but in terms of the process and the overall advice and mistakes I've seen founders make, it applies across.
A lot of the kind of tax areas and share options things do apply to different types of businesses, not just tech. I think there are certain rules, especially around EIS and SEIS, in terms of the businesses being risky businesses, and therefore some of these schemes might not apply to all types of businesses, but a lot of the kind of concepts would cross against different businesses.
Okay, so then this is kind of a question just for everybody, so we can chat around, but where do you think the biggest disconnect is between founders' priorities and the actual risk areas they should be focusing on?
I feel like when I see early stage founders, if they've just got funding and the bells and whistles, I would call it, right? The marketing and the glitter and the making it look pretty and nice. I think they've over-focused on that and under-focus on keeping the cap table up to date, having a shareholders or founders agreement, those basics that we've all talked about. I've got funding, exactly what Ben said earlier, so let's appoint 100 people. Forget the bells and whistles and how the prettiness looks outside. A lot of focus on that, and there should be some extent of focus to that, obviously, from a marketing perspective. But I think it's really important to get those basics right. What we hear often is, we'll do it later, or legal is only important once it goes wrong, or maybe we're too small for compliance. It doesn't matter if you're small, only if you're just 2 people and the company doesn't own the IP, as I explained earlier, that could be a disaster for the company. So yeah, that's my view of it.
Yeah, I'd say two main areas. I think one, founders thinking they can do everything. and they're experts in everything. And I think, like I mentioned before, I always would recommend founders to focus on your specialties and either bring in external support or team around you that focus on key areas. So a founder, for example, who's not very good on the finance side, sometimes I see them trying to do all of their own bookkeeping, doing their payroll, and that's just pulling their headspace away from actually focusing on what they're trying to develop, what the product they're trying to move on. And so I think focus on the right areas, the areas that you're passionate about, and bring in support to the other areas. One pitfall I also see is once you've raised money and you kind of start wanting to increase spending, that funds can run out quite quickly if you're not careful. And I think one of the pitfalls I see quite a lot is that you're looking to raise or do your next fundraise at the wrong time. I would always recommend the best time to go for a fundraise is when you're not desperate and when you're not running out of cash in the next 2 or 3 months. Because the amount of times I speak to clients and they say, yeah, we've got 3 months left on our run and we need to raise money, and they start giving away silly equity because they kind of get desperate. If you're doing that a lot earlier, and then whether that's 12 months before, and you start having those conversations, and actually, because you're not under time pressure, you can start actually negotiating some good terms, making the right call on who the firm or who the VC or the private equity that you're going to partner up with. Because again, this is a long-term relationship and you want to pick the right partner, and you don't really want to pick anyone who's going to put money on the table. If you're going to the VC space, picking the right VC that's going to actually add value to the business and add support that you need to take the business on, and it's not just giving you cash. I see that quite often, that people get desperate and just take money from the wrong people and at the wrong time.
Yeah, I'd echo that, Ben. What I was going to say is very similar. In terms of priorities, founders have got to work on the business rather than in the business, and make sure priority-wise they've got all of their ducks in a row in terms of what they need to do legally, financially, hiring, all the areas that aren't there. You need to, as Vicky said, potentially look to outsource or certainly partner with somebody who's going to work with you. But your responsibility as a founder is to focus on the business and not, your passion is the product or the service that you're building, but you've got to give the trust to the people that you bring in and hire to do that part, and for you to grow as a CEO and build the business from there.
And the
Absolutely.
outsourcing as well is a really measured kind of cost as well, where you don't have the responsibilities of an employer and the honor employment contracts and different things like that. If you hire fractional services or outsourcing and things like that, it's something that you can budget for or tailor for as well. You might need overview monthly, but it might not mean that you need a full set of management accounts and things like that. So you can probably tailor it if you are, penny pinching at the beginning, to kind of make sure that you can get the services that you need, that you're still compliant, but that you can focus on what you need to focus on.
I can add to what Marcus said, Gemma. I think as a founder myself as well, it's a hard lesson to learn that your time is best spent on what you are good with.
Yeah.
You focus on that. Don't spend time on trying to draft a contract that you know nothing about and it's not going to protect you in the end, or to try and do the bookkeeping, maybe, research tax on ChatGPT or somewhere. Give it to the people who know, because they're going to charge you for 15 minutes or half an hour in any event where you've spent 6, and your time is valuable in a business, working on the business, as Mark says.
Yeah. And you can always go by, even people that do use the internet, do use a provider. You can see testimonials and you can look at reviews that are reputable, people go on to Trustpilot and do different things like that. So there is other ways of getting around, making sure that you've got someone who is qualified in the right way. They've got a good reputation. They're going to look after you and different things like that. So there's other ways to use AI and the internet without trying to do all the difficult stuff. But if a founder is on a tight budget, how would you suggest they balance cost management with getting these fundamentals right?
Yeah, I can jump in on that one. So
Yeah.
I think it's definitely hard. And I think, like I mentioned earlier, partnering up with the right people that are part of the journey and are for the long term. And therefore, look, I know, speaking to the early stage startups, that sometimes it can be a bit of a loss leader, because that they're short of money. They're not going to be able to pay the fees that you would normally charge, and therefore you need to take a long-term view that you're on this journey with them. So number one, partnering with the right people. I think making sure that you're spending the money on the right things and not the wrong things. So you might have a set amount of funds and actually helping or working through where does that need to go and what are the priorities. And yeah, I think just focusing on like what the business priorities are for the next 3, 6, 12 months and what do you need to get you from A to B. And that might be you need to sort your contracts out or you need to sort your cap table out because there are priorities. But actually, from a hiring point of view, what is your hiring plan? And I think having a very early plan on covering all of these areas, whether that's a proper, I mean, I would always recommend having a full kind of slide deck, a full business plan, but making sure you've covered all these different areas and speak to the right people that can help you put this together. So you've got a plan in place and you can follow that plan. And it's very easy to, if you don't have that plan, to say, oh, I'm going to spend this money here, this money there. And actually, before you realise, you haven't got anywhere from A to B because you've just kind of jumped all over the place. So I think, yeah, having that business plan at day one, following that through.
Yeah, amazing. We have a question here, Vicky. Vicky mentioned AI and the dangers of relying on this. Are there any tools or AI software that you think are helpful for founders in each of your areas right now, or is AI just too early stage?
I won't say necessarily that it's too early stage. I think AI is going to remain a very powerful tool, but in the right hands. So it's that old adage of you don't know what you don't know. So let's say I give AI a very limited information and say, draft me a shareholders agreement. I've got 2 shareholders, and it spits out a 2-page product for you. If you don't know what should be in there, if you don't know what liabilities you're looking to circumvent, or if you're trying to protect yourself against, if you don't know what ownership should look like and a bunch of other things that would be in a shareholders agreement, when you can kick someone out, for instance, then you wouldn't know that it's a good or a bad product. And that's where your group of advisors that you are using, that we've been talking about today, is really important. So you can use AI to get you 60, 70% of the way there, actually. Get your contract together, but make sure that you also get the advice to take that further and make that bulletproof. I think that's the advice. I was specifically talking about the dangers of relying on an AI product to build your product on top of. So just to be clear on that, that's really dangerous because right now there's no guarantees to you that that product is going to continue existing, for instance, or that they are going to continue allowing you to use that in such a way and to resell. And people are getting very excited about the possibilities of what it can do, which is great, but also have that long plan, have that business plan that Ben has spoken about. Literally just go sit and map out what is important, what is the foundations. Don't build on quicksand. What if ChatGPT switched it off tomorrow? What if they said from tomorrow nobody's allowed to use our product anymore for commercial purposes? What's your plan B? Do you have a plan B? So make sure you've got a plan B and that's budgeted for if it needs to be, etc. So I think that's the important thing with AI. Don't think that AI is going to take over everything. However, I think AI has got a big role to play in the operational stuff. It can make things faster, it can connect it better, it can give you better views of your business, summaries, etc. So it's about, maybe even from a legal perspective, there's really nice products right now that can review a contract for you and just give you the basic idea of what it's about, what your liabilities are, what's your costs, that kind of thing.
I've actually got a real life scenario on this on AI because I probably get clients message me on a weekly basis saying, oh, I've looked up this on ChatGPT. Is this correct? So I had about 2 weeks ago, we did my brother-in-law's tax return, his personal tax return. And I sent it over to him and he said, oh, that liability looks different to what I calculated using ChatGPT. So I said, well, look, send me over your ChatGPT working. So he sent me it over and it turns out, everyone might or not know, in the UK you get a 12,500 or just over 12,500 personal allowance, and ChatGPT didn't take into account his personal allowance.
Big difference.
So yeah, I mean we're talking about a few £1,000 difference here. I think that is just one example of that you need.
And lots of people have different allowances for different reasons. If it's the questions that you ask it, isn't it? If you're just asking a basic question, but not everybody has the same.
But I think, like Vicky said, it's definitely, I mean, look, it's amazing. It's going to make some huge changes to the world in the next few years. And I think from a tax point of view, for people that don't have any tax knowledge, it can definitely help give you some kind of put you on the right pathway. but it's not quite there yet to say, actually, I can do this all myself, because
Yeah.
it's not 100%. And if you don't have that basic knowledge on what you're actually asking it, what it's going to chuck out at you.
Need to know what
the
you're looking
learning of the
for.
hard way, isn't it, really? Then that's the shame of it. But look, we've got 3 minutes left. So one last question just to all of you. So what's one piece of advice you wish every founder heard before launching their business?
I would say plan ahead and then plan again. You see so many founders that have built fantastic product, but they've not got a roadmap of where they're going to go. They haven't got a 3-year, 5-year plan, and they then become very reactive. They become reactive to not having what we've spoken about today, all the right processes in place, all the right agreements in place, all the right financial systems in place, or hiring plans. So plan ahead, take as much advice as you can from other startup founders, even from investors, VC, businesses. Just take as much advice, take it all on board, but make sure you're planning. It's imperative that you do that and not just think, well, I'm not even looking ahead to next week. You've got to look ahead and plan where you want your business to go, and more importantly, how are you going to get there?
Yeah, I can add to that. So I think before your first code, before your first hire, before your first major customer, spend that time mapping your legal foundations, your accountancy foundations, just mapping out the plan as we've discussed now, and getting in place people who you can go to ask those questions. There's lots of companies who help startups. All of us have said we specialize in this. This is what we do. We've seen it all. And you cannot top 30 years of experience and mistakes that was made and fixed by using AI, for instance. So my view is, biggest question from a legal perspective is, who owns my IP? Who owns what I'm selling? That's really, really important. Second one is, do I have the paperwork in place, plainly put, to make sure that is so? And don't build on quicksand is my advice. Foundations are really important to make sure that you're not just going to scale, but you're going to survive for the long run.
Have you anything to add to
Very
that? It's
quick.
just 11 now. Yep, go ahead.
So I'd say number one, have the right advisors around you, vitally important. Number two, be selfish on your cap table. Don't give away too much equity too early, because you'll live to regret it. And yeah, I think making sure that business plan you've put in place, you've got something to try and follow. All plans change as times go on, but at least you've got something that you can try and stick to. So last point also, because I see it all the time, is put time and energy to partner with the right investors, because you don't want to, once you've partnered up with the wrong investor, it's very, very hard to get rid of them. So make sure you're picking them for the right reasons and they can add value to the business.
Amazing. Thank you very much. Well, thanks to everyone for joining our webinar, What Tech Founders Get Wrong About Risk and How to Fix It Early. We hope you are able to take away some of the critical insights discussed today, and a big thank you to Vicky, Ben and Mark. Promise we shall share the recording, and if you have any follow-up questions, please do reach out. Thank you very much.
Thank you.
Thank you, everybody.
Thanks.
Thank you.
Thanks.
Bye.
Bye.